Everybody, it is Brian Shannon here from AlphaTrends.net. Today is Tuesday, July 6, 2010, and let's take a look at these S&P 500. The market, as we know, we've been looking at this retracement level off of the March 2009 lows to the recent highs, and we've seen that so far the market seems to want to hold above that 38.2% retracement level that actually comes in at 101.11. Last week's low was 101.13. Below that, we have the 50% retracement down at near about $95 a share. I also wanted to point this out. A reader had mentioned it to me. I'd failed to keep an eye on this rate lately, but the line I'm drawing right now, I'm not controlling where the line goes, but just the time that it takes to draw it. And this is the volume weighted average price line. So what we're doing is we're taking a look at the volume weighted average price since the March 2009 low, and we see that the average price for the market for the S&P 500 has been right about 102.30 or so. So that adds some further significance to that level, that if we break down through it, then perhaps we are going to see at least a test of this low right here is about $99.57, and perhaps we continue down to the 50% retracement. We've just seen that recently actually in the RTH. The RTH is the retail holders, and the retail holders looked like maybe they were going to try to hold the 38.2% retracement a week and a half ago at that $90 level. But what I was pointing out in the case of the retail holders is that what we want to do is we always want to look at what's the direction of the 5-day moving average. And when the RTH was at that 38.2% retracement, or about the $90 level, you can see here it was still below the declining 5-day moving average. So Fibonacci doesn't mean go in and buy. It means keep an eye out for the opportunity to buy, but and that is that we want to see the 5-day moving average flatten out and turn higher, and a series of higher highs and higher lows. But what we see instead here, and looking at a 30-minute time frame right now, is that we still have a declining 5-day moving average, and that 5-day moving average is what acted as resistance intraday today as well. So this market, you can see, let's take a look at the this 130-minute time frame. You can see here that really where we found resistance today, just under that 104.5 level, was this prior support area. So that's not what we want to see happen. I had tweeted late in the day that it seems as though with all this, the failure of today's gap higher, that perhaps we need to see a higher volume flush out. And it's still possible. This is one bearish looking chart still. We were higher today, but we get the red candle because we closed, we closed down here. We closed below where the market opened today. So that's why we get the red candle. But we did close above Friday's close, just in case you're wondering why we have that. But anyways, this market, I still think we could see the S&P kind of get that little flush out, perhaps down just below 99 and a half area, and perhaps even down towards the 95 level. Of course, it could turn on a dime as well, and I think if we get back above probably about 105 or so, then we're going to see the bounce that a lot of people have been looking for. But right now, the evidence just clearly is not there yet. We need to see a break of at least 105 before we can think that this market has the capability of putting in a little bit larger bounce. And perhaps, if the market breaks higher, maybe we get up towards the 10 or even the 20-day moving average up near about 108 or so. But for now, it remains a very treacherous market. If you look at these, the futures, we gapped up to, the S&P gapped up today. But if you looked at them on Monday night, the futures market had us trading down really at about this level here. So overnight we had sold way off and then gapped higher. So it remains a tricky environment still if you're trading. I think that most people ought to be trading half positions, and you ought to be moving very quickly in this type of environment.